Welcome to another VC Wisdom podcast. We have Michael Frankel with us today, founder and managing partner at Trajectory Capital. This podcast is brought to you by podpire.com. If you want to start, scale, be invited to podcasts like this one, or even find sponsors, I can help you with that. That's my podcasting agency. Podcasting is amazing for learning. It's amazing to get to know new people and talk with them for free, basically. Grow your network, grow your net worth with leads and clients. And I can help you start your pod or scale it. It's podpire.com for that. Mike, welcome to the pod. Can you tell me a bit more about yourself and Trajectory?
Sure. So I've had a varied career. I've done sort of everything in the deal world. So I was an M&A lawyer. I was an investment banker, corporate development officer, buying businesses for a bunch of big tech companies, and then launched Trajectory Capital with a partner about a year and a half ago. We focus on acquiring control of small enterprise tech and data businesses that are growing but are not hyper growing. So we're not a VC. We're for those companies that aren't VC targets.
Right. Your background, you worked at a bunch of interesting companies that I saw here on your LinkedIn. So how did Deloitte, how did Merrill Lynch and VeriSign and GE Capital, how did these companies shape you as a professional?
Yeah, so I think for me, the two sort of complementary skills that I think I developed are, number one, how to execute transactions. I've done about 110 of them. I've been lucky to be in places that are very transactional, but at the same time, and I think in some ways more importantly, understanding how to create operational value, right? Doing a deal is only useful if 1 + 1 = 3. Whether that's taking capital, whether that's investing in a company, whether that's buying a business. And that's the skill set that I think is actually more powerful, is using, I think of transactions as a hammer. A hammer can either break a window or build a desk. So knowing how to use the hammer and where to use the hammer is much more important than having a hammer.
Right. And you work in these internal funds, if not sometimes accelerators inside these big companies. When did we started seeing that happening, and how are they different from the typical VC?
Yeah, they're dramatically different. They've been around for decades, but they hyper accelerated over the past 10, 15 years. Now, the number of corporate venture funds out there has grown exponentially, and they're radically different for this reason. If you're a large corporate, capital appreciation on a $1 million, even a $10 million investment doesn't move the needle. It really isn't relevant to you if you're a 20, $50 billion company. So while they certainly want capital appreciation, the reason people launch corporate venture funds is because of the strategic benefit they get. Otherwise, you could just put your money from your treasury department at a big highly successful venture fund. So the reason that people build corporate venture funds is because they want market intelligence, they want access to companies they might want to buy, they want access to technologies they might want to use, they want access to companies they might want to partner with, and all those strategic benefits that drive their core P&L, their core business, generally are much more important and much more valuable to them than we put $3 million in and we got $6 million out. And that's totally different than venture capital funds, who are in the business of putting 3 million in and hopefully getting 30 million out.
So my brain is picturing multiple stakeholders coming at one table, the HR being like, hey, I need this person, the IT being like, I need this system. Is it a longer and more complicated process for me as a startup to get acquired? What do I need to do to reach out to all these stakeholders and make sure that I am attractable to them? And is there one decision maker, aka you, in the past, that is pulling the trigger?
So unfortunately, there's not one decision maker. There are usually multiple decision makers. I think the key, if you're an early stage company, because the downside to corporate venture capital is it moves more slowly, right? The key is to understand what the company's incentives are and figure out whether you can add value to them, right? If you can't, it's probably a waste of time to spend time with them. So what is it they're trying to get out of the relationship? Are they trying to learn about your new technology and they're trying to learn about a market? Are they looking to build a product or a solution on top of the thing that you have? Figure out what the itches that they're trying to scratch, and then give them transparent information to help them make that decision about whether you're the right sort of solution for them. That's the way you can accelerate it, and understand who, to your point, who the decision maker is, because different corporate venture funds prioritize those 4 different areas differently. There are certain corporate venture funds that are all about pipeline to acquisition, right? There are certain funds that are all about we just want market intelligence. There are certain ones that are prioritizing technologies that we can turn into a product that we can sell to our customers. So you have to have a dialogue with them and say, what's important to you? What are you trying to achieve with your CVC? And then be honest with yourself about whether you're the solution to that, right? Because if not, you can waste a lot of time. Especially, here's the big danger. Remember that learning about the market thing? They get that just by talking to lots and lots of companies. They don't have to invest in you to get that. You do not want to be fodder for their learning experience. So figuring out what's the thing that pushes them over the edge from lovely to talk to you to we'd like to own 10% of your company, and then focusing on that is really important, because every CVC is different.
10% of the company, isn't it like a full acquisition normally? Like what is the average stake that they take?
So it depends on their strategy, but a corporate venture team always starts with a minority investment because they're sort of planting lots of seeds. And at some point, when the relationship matures, they call in the corporate development people to acquire the whole thing. In a perfect world, if you're a corporate venture fund, what you want to do is make the small investment, establish the commercial relationship, whatever it is. We license your tech, we go to market together, we build a product together. And once we see that it actually works, then we try to buy you before you get too big. So that's usually if we acquire you at all. Maybe we don't want to acquire you. And this leads to another key point for the early stage company. I've just talked about all the hassles associated with corporate venture capital versus traditional venture capital. The flip side is they can add a tremendous amount of value to your business, right? They can bring customers, they can bring technologies you need, they can bring the other parts of a solution. They can be your prototype customer, right? They can do pilots with you. Sometimes they can fund the pilots. So there are all these advantages to a corporate venture capital partner over a VC. You just have to recognize there's more potential reward, there's more potential hassle.
How much corporate venture funds are they, and generally speaking, and at what stage does a large company starts having one of these?
So it varies. Unfortunately, there's no clear line because it varies by industry and it also varies by leadership, right? So if you have industries that have a lot of innovation happening in the early stage community, they're more likely to have a corporate venture fund than if it's an industry that's more staid. But it also matters how the management team views innovation. Some management teams say, we're going to do all the innovation internally. Some say, we're going to work with early stage companies, but we're not going to invest in them. That just muddies the waters, right? We're just going to partner with them. And some want to invest. The other model that's emerging, which is really interesting, is what I would call sort of partially outsourced corporate venture capital, right? So you have the mega companies that have established massive venture capital teams. They're deploying hundreds of millions of dollars a year. They have a 100-person team. But if you're a company just trying to start corporate venture capital, it can be challenging, right? This is not something you understand. You don't have the talent internally. Hiring the talent externally is hard because you're competing with the VCs. So there are firms like, as an example, there's a firm called Touchdown Ventures, which basically runs CVC for the corporate. So the corporate makes the strategic direction. We want companies that look like this, but they don't actually do all the venture capital themselves because that requires a different skill set. So the answer is it tends to be big companies, but it doesn't have to be mega companies. A lot depends on, are you in a sector where CVC can actually help you? And is your management team of the mindset that we like to do this? And that just like literally totally varies company by company.
And does CVC compete with the innovation department in the company? Because I had Sean Shepard on the pod the other day. He's the founder of U Plus,
Yeah.
and they basically, yeah, help company create these innovation departments and
Yeah.
help them go or try to achieve product market fit at scale, which is beautiful. So
Right.
do these two departments compete together or do they collaborate?
They absolutely should not. I would say unless you have a really unhealthy dynamic, they don't. They collaborate. And because as an example, the CVC team generally doesn't know how to build things, doesn't have product management resources, product development resources. So the normal dynamic is they work together. If you think about it, think about internal innovation, acquisitions, and corporate venture capital as being different paths to develop new stuff. So they should all be talking to each other and interacting with each other, right? So the innovation team might say, ooh, we don't want to build all these technologies. Hey, CVC team, we'd love to get, proprietary licenses to some of these technologies, maybe with a non-compete so they don't go to our competitors. Let's make an investment so that we can use that technology. Or they might turn to the corporate development team and go, you know what, this technology has become so critical to a big thing that we've now validated is going to be the future of our company. Go buy that company, right? So the three groups should be interacting and transparent with each other and partnering with each other.
What are recent examples of very successful M&A in the tech world and humongous failure in the same realm?
So, nobody wants to name names on humongous failure, but I will say there are a number of examples I've seen of companies that have built products, and this is where CVC and the right innovation team can help. They have built products that are not needed in the market. That's the worst thing in the world. Or I can think of one company that spent $35 million to build a technology. I like to joke they were the Vasco da Gama of that technology. They said, oh, this is a totally new idea. And they didn't talk to customers. They didn't look in the market. And when they got out into the market, the customers go, oh, yeah, it's definitely an important technology. We already have 5 vendors. We don't need you. Then they ended up writing the whole thing off. I think the most successful examples, I mean, there are mega deals every once in a while, but in my mind, the most successful examples are not the mega deals. They're the large number of small deals that allow innovation to accelerate. Because the reality is, and this is something that especially I'm old enough that I remember when most people didn't think this way. A lot of people think we want to be the unicorn, we want to be the IPO, we want to be the next Google. The reality is 99 point something percent of tech companies do not become the next Google, but that doesn't mean they fail. That means they become a really valuable part of a much bigger company. And so the vast majority of innovation efforts and corporate venture efforts don't yield a public company listed on the NASDAQ. They yield that new feature in a technology that the customer goes, oh, that's great, they added that, right? Every time you see a new feature in, on the Salesforce platform, a new feature, a new component or a new product that Google is offering, that either came from an internal innovation effort, a CVC effort, or maybe an acquisition, or maybe 2 or 3. So in my mind, that's actually the big value creation. Every once in a while you have a home run, but they're pretty rare.
And once we're talking about an acquisition, I can't help myself but think of, new blood entering old blood.
Yep.
And sometimes it's not compatible,
Yeah.
like a bunch of founders were pirates and a bunch of large companies, they're pretty much the opposite of that. They're like the good student slash the
Yep.
teacher. How
Yep.
can we make sure that the merging and the fusion becomes profitable for both parties?
Yeah. Well, step one, and this is going to sound very nutty crunchy, but being realistic about yourself. So if you're a management team, yes, the idea of, oh, I get to be part of this big company and I make a bunch of money, is very exciting. You have to be self-aware enough to say, am I going to be able to operate effectively in that organization? And the buyer has to have the same conversation. And then you come to a solution. And I mean, sometimes the solution is don't do a deal, but oftentimes the solution is either A, keep that business somewhat isolated, right? So they don't get to entirely play by their own rules, but we're going to try to keep their culture a little separate. You don't have to wear suits. You don't have to come into the office every day. You get to do things a little bit differently, but within the constraints of a big organization, right? And at the same time, there's the traditional cultural adoption where when you buy a small company, the small company has to adjust to your culture. There's a flip side to that, which is if you're really trying to innovate, sometimes you need to adjust to the small company's culture, right? They're doing something right that you didn't think to do. So buyers, large corporate buyers, have to be self-aware enough to go, there's a reason they've been successful and that we wanted to acquire them. Maybe we not only need to let them continue to have whatever this culture is that they have, but we need to start to adopt it, right? We need to let the infection go the other way. Agile development is a great example of this. I mean, it's now an old example from 15, 20 years ago, but a lot of large organizations didn't adopt Agile. Little companies did out of necessity because they had to move fast. And when they were acquired, the smart acquirers said, wow, that's a much better development methodology. Let's start to train our whole organization in Agile. But yeah, it's a big problem. This is one of the reasons that if you're going to sell your company, you need to have succession planning, because the reality is, as a corporate buyer, I know that if I put $10-15 million in your pocket and you're a born and bred entrepreneur, it's not that you have any malicious intent. You're just going to get frustrated with my organization, with my TPS cover sheets. And so I might be able to keep you for a year and a half, because you'll honor your contract, but then you're going to want to go back and do, unless I can really find a weird niche for you, maybe on our innovation team where you get to keep doing new stuff, you're going to want to move on. And so when I'm diligencing your company, I'm going to look at the layer below you and say, in a year and a half, when Charles decides to go build his next successful company, is Thomas a strong replacement for him, right? Do I have a stable management team? Because maybe Thomas didn't make as much money and I have a better chance of retaining Thomas to be the new head of the business. But yeah, the culture stuff is something that people often ignore, and it kills so many deals.
Right. Product role also is one I can think of for many ambitious founders. Last question for you.
Yeah.
If I want to potentially expose myself, one, to CVCs, and second, to maximize the outcome of their investment in me, aka getting richer off that, what can I do to prepare my business a couple of years in advance to make sure that I'm an attractive target?
Sure. So I would say there's a couple of things. Number one, figure out who your natural buyer or investor is, right? Who benefits the most commercially from having your thing, whatever that is, right? So find those natural buyers and identify them well in advance. That's number one. Number two, without compromising your product roadmap, try to drive your product roadmap towards what they need. And that can mean feature functionality, but that can also mean all kinds of basic stuff in your organization, like, are your contract terms the kind of contract terms they'll want with their customers? Do you have the right IP rights, right? Open source code is a great example. Lots of little companies use open source code. Nobody's going to sue them. I can tell you, as the corporate buyer, exactly 3 seconds after I acquire your company, if you have violated open source code terms, someone's going to sue me because I'm deep pockets. So, build the technology right, have the right succession planning, think about your brand in the market, think about how they're going to use you. Think Lego pieces. I'm a corporate buyer, and whether I'm making investments in technologies or I'm acquiring the companies, I'm building this giant Lego set, and I have all these gaps where I need Lego pieces. Make yourself as much of a perfect Lego piece to go into a gap as possible, and I will pay more for you. Because honestly, if you don't do that stuff, I'll be totally frank, when I look at your company, I go, okay, I'm going to have to spend $1 million to do this and this and this, reduce purchase price by $1 million. I'm going to have to spend $5 million to do this and this and this, reduce purchase price by $5 million. I'm going to end up at the same return rate that I need to have. The less expensive absorbing you and getting the value out of you is, the more I'm willing to pay. I don't care one way or the other, right? I'm just getting to the same price. So every time you save me money, I'm glad to put it in your pocket.
Love it. Thank you for that, Mike. Where can people find out more about you?
Yeah, so you can ping me at michaelfrankel.com or trajectorycapital.com, and love to talk to people.
I'm Charles Cormier, host. That was another VC Wisdom podcast with Michael Frankel.